Hey, this is Bubble Analytics, and this week we are creating a strategy around a brilliant indicator called the CMB Composite Index. It's wholly underutilized in my opinion. I never really see anybody posting charts about it, but effectively it's a three-line indicator composed from two lengths of RSI. So it takes RSI 14 and RSI 3. The main line is the composite index line rendered here in white, and that takes the 9-bar rate of change of RSI 14 and adds it to the 3-bar simple moving average of RSI 3. And from that composite index line, we create two averages, a fast and slow average. Fast is at 13-bar simple moving average, and slow is a 33-bar simple moving average of the composite index line. So for our triggers, for a buy, all we're looking for is the composite index line in white to cross above the fast line here rendered in red. That will be our buy trigger. And for a sell trigger, we are looking for the fast line in red to cross below the slow line in blue. So the idea of this strategy is that the composite index line spots an early momentum term, and moving above fast confirms the trigger, and then we're using the slow average effectively as our exit filter. So if you are ready to code this up, we will make a start. So first, please read the disclaimer. Okay, let's start coding this up then. And to begin, I've opened up a fresh Jupyter notebook, renamed it CMB, and I'm just going to click inside the first cell, hit shift return a few times to create some empty cells. We will be pasting into there from our template. The template just contains code snippets that we use each time to create a strategy and then backtest it. Both the completed notebook and the template will be available to download for free. You can get that via our GitHub profile. Link is on the website in the footer just here. So let's get going then. First job, as always, is to import your libraries. And I'm just going to copy that entire code block there and paste it in, then hit shift return to initialize it. Next job would be to download some data. As usual, we are going to start with 10 years worth of daily data for QQQ. If I hit shift return, this is what the output looks like, and the key line is the one right at the top there. I'll just comment these out. We are using the Y Finance library, which we renamed YF, using their download method to take 10 years worth of daily timeframe data on QQQ and store it in a variable called DF. Anytime you want to see what's in DF, just write the variable name and then hit shift return, and this is what the data comes in raw format. That's what it looks like, and all these lines in the middle here just tidy it up into a more sort of readable OHLC data format. So with our data downloaded, let's get on with the indicator calculation. So CMB Composite Index, I'm in chart school here. This is what it looks like here in this image. So it's a three-line indicator, and in order to calculate the main line, the composite index line here, what we need to calculate is RSI change and RSI momentum. So that's the 9-period rate of change of 14-period RSI and the 3-period simple moving average of 3 periods RSI. So we are also going to need to calculate RSI then, and the RSI calculation is here, but in effect it calculates the bar-to-bar difference in price, separates positive changes from negative changes, then averages those positive or negative changes over whatever look-back period you're looking for, and then relative strength is effectively the average gain divided by the average loss, and this line here just converts it into a bounded oscillator between 0 and 100. So we'll do that bit first then. So let us define a function called RSI, and RSI is going to take in some data from our data frame there, and also N, which is representative of the look-back period. So the first thing we need to calculate is the price change, and to do that we are going to be looking at the difference in day-to-day readings on the close price. So we take our data close column, and then we are going to use the diff method, and that will just return the difference between the current one and the last. So next we're going to separate positive changes from negative changes. So we're going to create two new variables, one called up, one called down. And that is going to take the price change that we calculated above here. And then we're going to use the clip method. For the positive changes, the lower bound is going to be equal to 0. So effectively, all that means is we are going to clip any value at 0 or less and only record the positive changes. If we do get a value of 0 or less, it's just going to record it as 0. We're going to do the same thing for the negative changes. So if I just paste that in, but this time we're going to set the upper bound. So we want to record the negative changes this time. So anything at 0 or above is recorded as 0. Anything under 0 is recorded as that value. And then because we don't want negative values within the data set, we're going to chain on the absolute method in order to remove the minus sign effectively. So now we've got our positive and negative changes separated. We're going to average them out. So let's do average up and average down. And for this, we're going to use Wilder's smoothing to calculate an exponential average over values equivalent to our look-back period. So we're going to take, so average up then, we're going to take the values in our up variable here, and then we're going to chain on the exponential moving average method, which is EWM. Normally you would tell it what look-back period you want, so you would say span equals 14, for example, or in our case n, because n is representative of whatever look-back period we're looking at. But in this case we're using Wilder's smoothing, so that's alpha equals 1 over n. And then because we don't want it to adjust values in typical weightings for an exponential moving average, we are going to set adjust equals false. And then once we have our 14 values, we are going to calculate the mean from them. So normally you wouldn't have that alpha equals 1 over n, but in this case, to be true to Wilder's smoothing method, then this is how you would do it effectively. So with the average down, obviously we're going to take the values in the down variable here and then apply this exponential moving average to it for our look back period n. So once we have that in place, relative strength is therefore average up divided by average down. And our RSI value then is equal to, I'm just going to remind myself, so it's 100 minus 100 divided by 1 plus the relative strength. So that would be 100 minus 100 divided by 1 plus RS. And then from that, we're just going to return RSI. And now, anytime we wanted to create an RSI for whatever look back period it is, we would just tell it where to store the column. So in our case, we're going to be adding a column into df here. So df, and then call the name of the column, which is going to be RSI 14. And that is equal to call our new function RSI, tell it where to find the data, which is df, and then what look back period we're looking for, which is 14. And that's now going to create a new column within the data frame. In fact, let's go and have a look. So there you go, new column RSI 14. And if we want to do, we're going to need RSI 3 as well. So let us just copy and paste that. I'm going to change that to RSI 3, change the look back period to 3. And there we go, 2 new columns, RSI values for each. So now that we have that in place, we're going to be able to calculate the CMB. I'll do that in a new cell just to separate them out a bit, but what we're looking for is, I'll tell you what, let's just copy that whole thing. This is what I would normally do, copy that whole thing and then pop it in here, and then so we know what we're looking for. So we're going to define a function called CMB, and CMB is just going to take in some data. Basically we only need to tell it where to find RSI 14 and RSI 3. So, and then the first one then is RSI change. So RSI change would be equal to the 9 period rate of change of 14 period RSI. So that would be data.RSI 14 divided by, minus the value 9 periods ago, so data.rsi14.iloc minus 9. So effectively what I'm saying there is take the current value of RSI14 and deduct the value of RSI14 9 periods ago. And then that would then be divided by data.rsi.14 9 periods ago to calculate the rate of change, and then multiplied by 100, and we're going to need some brackets, aren't we? So let's bracket that one up and that one up, and then we're going to need a bigger one for this and this. So that's RSI change. We can get rid of this line, and then RSI momentum is going to be equal to the 3 period simple moving average of 3 period RSI. So that's really straightforward. So we're going to take in data.rsi3, and then we're going to use a rolling window of 3 periods, and then from that take the mean. So effectively we're taking the last 3 values, or a rolling window of the last 3 values of RSI3, and then calculating the average from it. So once we have that, our composite index line CIL is going to be RSI change plus RSI momentum, and then from that CIL line we're going to calculate the fast and slow lines. So fast, slow, and that they are simple moving averages, 13 period simple moving average and the 33 simple moving average of CIL. So again, CIL, and then use the rolling method, take in a rolling window of 13 CIL values from which we calculate the mean, and I'm just going to copy and paste that to save a little bit of time. And this one we're just going to change to 33. So, and then from this, now we can get rid of this, look, but from this we want to return CIL, fast and slow, and then to create new columns within our data frame, tell it which data frame we want to add them to, and the column names. So CIL for 1, and then DF fast, and here we go, slow. So that should be right. Yeah, and that would be equal to call our function CMB, and then tell it what data we want it to look at, and that is DF. So if I now run this, we should see we have our 3 new CIL fast and slow columns within our existing data frame, and we are going to, I can close that down now, recreate this chart with this 3 lines. So CIL there is in black, and then I think fast is in green, red is in slow. So we're going to recreate that now on a chart. Before I do that, I'm just going to get rid of these nan values, these not a number values. They're only there because at this point in the data set we don't have enough values to calculate this 13 period SMA or the 33. So anytime you get that, it's going to put a nan value in there. So we're going to get rid of that using the drop NA function. So tell it which data frame to look at, and then tell it we want to drop the NAs, and then do it on the existing data frame like that. And have I spelled that right? Yeah. So there you go. So now we've got rid of the nan values, and now we've got a really nice data set. Obviously we've lost the first 34 rows in order to calculate that average effectively, but we have values now for RSI 14, 3, composite index line, fast and slow. So next step then would be to recreate this on a chart. So I'm going to come into my template, and this is going to be sort of looking at this. So what we have here is price above and the indicator below. So this is all one column with 2 rows, price on row 1 and the indicator on row 2. So I'm going to come into our template here, find the subplots bit. So what this does is make a subplot here with 2 rows, 1 column, shares the axis, and says price gets 68% of the screen real estate, and the indicator gets 32%. So I'm going to take this whole bit here and come back, and I'm going to leave a little bit of a gap, but I'm going to pop that into our code book here, and then so that's price and subplots, and now we're going to add some indicator data to our indicator subplot. So that's this bit here. Now there's 3 lines, so we're going to have to paste this one in three times. So, and then we'll set that up now. So first one is going to be the composite index line, which we named CIL in our column. So these have got to match the column names. So that's CIL, and I'm going to pop that in there and make that white. And then next would be our fast line, which the name there is just so that you see it on the chart. So there's fast, and I'm going to make that red. And then the one at the bottom here is our slow line, and I'm going to make that, I'll keep that the same actually. So that's our indicator data now added. So we've got price here, and then in row 2, so price is in row 1, and in row 2 we have our 3 indicator lines. So once we've got that in place, let's go back in and start setting up the chart. So what I'm going to do is just grab all of this bit here, and then we're going to amend it slightly. If you keep this line if you want to save an image of your chart, so you would just rename it what you want, CMB for example. And then the bigger the scale number is how crisp you want your chart to render, bigger file sizes for bigger amounts. So, but I don't need that, so I'm going to delete it. And then this part here, all this does is set range breaks. So when Plotly renders price data, it doesn't recognize that stock markets don't trade on weekend days. So effectively it's going to render gaps in your price data for Saturday and Sunday. So with this range breaks here, we're going to update the range breaks so that it gets rid of data starting on a Saturday and ending by Monday. So effectively we just get rid of Saturday, Sunday. And then all these bits here do is set the width and height of your chart, the template or the theme that you want to, the Plotly dark theme obviously, and then I've updated the grid color because it's a bit garish under the default. So once we've got that, the last thing that we want to do is, because we've updated the range breaks, is we want to set the date column as the index, and I'm going to put that just above here. And if I now run this, I'm pretty sure we've got more or less what we need, but it'll tell me. Oh no, there we go. So if I now run this, what we've got is a nice month and year down at the bottom here, and our 3-line indicator is rendered just like it is here in stock charts, and we have price above, and then our legend, so what each line is. So the white line's CIL, and fast in red, and sort of greenish for slow there. So that's nice and everything, but we're just going to make a few little amendments. One, we're going to display the last values. This is displaying the first 200 bars. So this part here is so that we can take a slice of our data. It's starting at bar 0 and ending at bar 200. What we're going to do is make that 350, and we'll start this at 2150 for a total of 2500, and basically we'll get the last set of bars. So if I now run that again, we've got a more up to date looking at it. So this is the most recent price action, and what have we got here? So if you have a look at our indicator, you can see that 100 seems to be more or less the top. 50, we automatically get a little grey line up, 0. And normally you wouldn't sort of put any horizontal lines on this, but I always think it's quite helpful. So we're going to come back in and add H lines to our indicator plot, and so I'm going to grab this little section here, and it's basically just adding a levels line onto your indicator, one that's going to move across here. So if I come back in here and just add that there, we're going to need 3, and I want 1 at 100, 1 at 50, and then 1 at minus 50. And if I now run all that again, we should see, so we've got a nice little indicator. Now you've got more of a frame of reference. I always think that's helpful. Don't know if you guys would agree, but there we go. So if you wanted to make it nice, look, tidy up the sort of format and everything like that, you would add in something like this, which is to add a title. So if you wanted to add a subplot title here, or a chart title, that's there. You could go in and add that one there. I we'll do it just for, why not this? So CMB composite index indicator, and what this xref and yref paper means, all it's doing is setting up grid lines across your chart here, and this is like a 1-to-1, so 0 to 1, 0 to 1. So on the x-axis, 0 here, 1 here, so the far end of your chart is always 1. So, and because I want my title to come here, I'm using 1, so it's basically going to end at 1 here, and then the 0.2, which you see here, indicates how far up. So on the y-axis, this is 0, this is 1, 0.2 is probably about there. So I'm going to, I'll tell you what, let's just run it and see where we end up. Yeah, so the label sort of on there, so we're going to move that up slightly, and to do that I'm just going to change the y value to 0.35, and that should be, yeah, there you go. You can probably bring it in a little bit lower, but that should do for now. So that's our chart created. Let's go and now create our strategy and then render buy and sell markers onto our chart so we can see if it works and whether it holds any kind of promise. So going to come back into our template then, and what we are going to do is take this section here. So this is a signal function. All it's doing is running through the length of your data frame, row by row, looking for your buy and sell parameters to be hit. So so the signal function here, it creates a variable called signal and makes it the same length as your data frame, and then pre-populates that with a 0 value. And then this is the loop, so this is the key line really. So we are running a loop starting from value 2 all the way down to the end of our database, so running line by line over the data frame, and then looking for these parameters to be hit. And I is representative of the current value, and I minus 1 yesterday's value, I minus 2 2 days ago's value, I minus 3, so on and so forth. So where you see I here, it's just telling you which row you are looking at from the current. So for our strategy then, what we were going to look at is crosses of the CIL line above the fast line. So that's going to be our entry trigger to buy. So when white crosses above red in this particular chart, that would be a signal to buy, which you can see happened on April the 9th. So typically, so really you should see a buy signal here. So that will be our buy signal. Let's go and code that one in. So data.cil.ilock I minus 1. So what we are saying there, I minus 1. So what we're saying there is take the value of CIL on the bar before last. So if data.cil is less than data.fast.ilock I minus 1. So if the value, yesterday's value of CIL was beneath yesterday's fast line, and today's value, so I'm going to just copy that and paste that there, and today's value, so today's value would be I, yesterday's value would be I minus 1. So, and today's value of CIL is above fast. That would qualify as our buy signal, and please put a 1 in our signal column here. Okay, and then for I'm just going to copy that whole thing. So for our sell signal, what we're looking at here is our fast line crossing back below our slow line. So for example, that looks like a sell signal there. So you can see that red is above green up until about this point, June the 6th, at which point it crosses back below it, and that would be a sell signal. So let's add that add that in here. So okay, so what we're saying is if yesterday's fast line is above yesterday's slow line, so we'll change that to greater than. So if yesterday's fast line is greater than yesterday's slow line, and today's fast line is less than today's slow line, that would count as a bearish cross, and we are going to put a sell signal in there. So we're going to class that as 2. We'll put a 2 in our sell signal column. And then this just creates a column within the data frame called signal. And then when I run that, what you should see is no signals there for the time being. Let's just have a look at the last 40 values within the data frame. Okay, there you go. So you can see you're getting signals here. So for example, let's look at this buy signal on this line here. To qualify as a buy signal, the composite index line had to be below the fast line on that date. You can see that quite clear it is, and then back above it on the next day, which again you can see it is. So so that seems to be working. Let's get rid of that. But in order so that we can have a look at it, let's visualize that on our chart. And to do that, we're going to take all of this code snippet here. All this does is create functions to add 2 new columns into our data frame, one for long entries, one for short entries, and give us a price that we can tell Plotly to put a little marker there. So all it's doing is running through our data frame, looking for a 1 or a 2 in the signal column. Where it sees a 1 in the signal column, it takes the value of the low column minus an offset. And where it sees a 2 in the signal column, a sell signal, it returns the value of the high price plus an offset. And then these lambda functions basically just incorporate this particular function within here in order to add that onto our data frame. So if I now run this and then add it in here, what you can see is we've got 2 new columns. If I go and have a look at, again, the last 40 entries, and you can see there, so where we got a sell signal equals 2, we got a price in our short entries column, and that price is what Plotly is now going to use in order to put a marker there to tell it that we had a sell signal effectively. And then these on our value counts, what I'm looking for there is tell me how many times 1 appeared in our signal column, tell me how many times 2 appeared. So you can, if you're running your strategy and you're finding that you've got very little buy or sell signals coming up on there, then obviously you want to amend your strategy before you go to the trouble of trying to backtest or anything like that. So, we're ready. So we've got 192 buy signals and 22 sell signals. So let's start the backtest then. Oh, sorry, I didn't add them onto the chart, did I? So to do that, we're just going to take this code snippet here, named entries, back from our template, and just paste that into Plotly. And all that is doing is taking the values in the long entries column, creating a marker, and then we want to make that size 7, make it an arrow up. There's lots of variations here. So buy signals are going to be a white arrow up, and sell signals are going to be a gold cross. All right, so let's run all that again and have a look at it on the chart. And what you can see now is buy and sell signals. And if we were going and check our data, remember that one on April the 9th? There we go. There's your corresponding buy signal. That would have bought in at the open, which I believe would be there. So, and then we got a corresponding sell signal, buy signal, another buy signal, so on and so forth. So now let's go and create our back test. So the first thing I'm going to do is come into the template and just copy this whole thing. And then paste it into our code book here. So all this, and I'm going to tidy this up a little bit. So this section here is if you wanted to sell after a certain amount of time. So if you could have a strategy that said, okay, go for a 3% profit target and a 3% loss, but if you're still holding it after 5 days, just close it. So, and if you wanted that, you would change that to days equals 5. So, but we're not doing that this time. And then we're not going to trade on the close. We're going to trade at the open of the next bar following a signal. And we're not going to hedge because we have exclusive orders equals true. So effectively we can only hold one position at any one time. And then our commission there is equal to a 0.1% fee for a completed trade, so a buy and a sell. And then no margin means, or margin equals 1 means no leverage. So no leverage applied in the portfolio. We never start with leverage at all. And then a starting cash is going to be 100 grand. and we're going to be using the data in DF, and we're going to be running the MyStrat strategy class here. So effectively for this code, all it does is take in the values for the signal column, creates a strategy class called MyStrat, initializes the strategy and the data in the signal column here, and then when it runs through and it sees a 1 in the signal column, if we are already short, we close the position, or if we don't have a position, either eventuality, we buy with a size equal to 99% of our available capital. And where we see a 2 in our signal column, that's a sell signal. If we're already long, we close it, or if we don't have a position, either way, we get short with 99% of available capital. And then this line here, all this is doing is setting up a price we can key from to set stops, basically, so profit target and stops. So let's run it raw just to see what it would give us. And it doesn't do too badly. You're in the market, obviously, 100% of the time. And the reason for that is the only time you are selling is when you get a sell signal. So, for example, during this section here, once we got that sell signal here, we closed it only when we got a corresponding buy signal, and at that point we were long all the way up until we got this sell signal, from which we were short, and then this buy signal, and then following that buy signal we were long until there. So basically we're just flipping between long and short all the time, never taking profits until we get a corresponding buy or sell signal. So not the way to do it. You can see it still makes money either way, and that is extremely encouraging, definitely. But the number of trades, 124, so that's how often you would flip back between long and short. The win rate is about half, not great. The worst trade, awful. And your drawdown is probably about right for what QQQ would give you. Maybe you've swerved about 7 or 8% there. I think the biggest, over the last 10 years, I think the biggest pullback in the market was just about 40% in QQQ. So, but effectively you're taking what the market gives you, flipping between long and short. Not a bad strategy either way, but definitely where we can improve upon that. So what we're going to do now is add in some stops and losses. And to do that, we are going to key from this price level here. So when we set for example, when we set a take profit target, we call it TP for take profit, and then we tell it what percentage of this level we want. So this price is the closing price as of a buy or sell signal, and then we key from that. So take profit would be, if we wanted 3%, it'd be 1.03 times whatever that price is. Okay, so and typically for the Qs, that's what I will start with. And what I normally do is just comment out this sell signal. So we don't want to flip short when we get a sell signal, just for the time being, but we do want to close longs when we get a sell signal. So we're just going to comment out this line here, so that we can have a look at what happens on the long side. So all we're looking at now is buy signals, and with a 3% profit target. And you can see the return's gone up. You're in the market a lot less, about half the time. The return has gone up. The drawdown's come down. Your win rate's really good, but only because you're never getting stopped out. But your worst trade is still that 19% one, meaning that you got long at some point and got a corresponding sell signal 19% lower down. So we'll see what we can do about that. Obviously, we just want to, you want to give with stops. Stops can kill a strategy, and you should be using them, but you can't do it to the detriment of your actual gains. So, for example, if I set a stop loss here at 0.99 times price, or 1% stop, and run this, it will kill the return. So we went from 300% to 92%, and it will kill the win rate, because you're just getting stopped out all the time. And yeah, your drawdowns are less, and your worst trade is far less, but you're trading a lot more, and you're not winning the majority of them because you are getting stopped out before this has had a chance to make a profit. So you always want to give your stops a good bit of room, but you want to avoid the worst of your worst trades. So that worst trade was 19%, and it's now 11%, which is still horrific, but given that your maximum drawdown is dropped to sort of minus 17%, and you haven't really impacted your return. So we've gone from 300% just about to 299%. So that's not bad. I think probably I would stick with that. And then on the short side, again, what I would normally do is just comment out the buy side for the time being. And then let's have a look at shorts on its own. So shorts with no profit targets or stop losses would make you a negative return and extremely low win rate. Drawdown's terrible, but your worst trade was only 7%. So effectively, over the last 10 years, if you went short, you would get a buy. You would have had a buy signal within 7% of that, which is not too bad at all. So what we're going to do then is set some stops and losses on this as well. And typically, normally tend to go about the same sort of price level. So if it's QQQ, I would normally go around 3%, 2 or 3% for a profit target. So in our case, because it's a short, the profit target is underneath the price that you buy in. So it is going to be 0.97 times price, as in 3% of there. And then you can see immediately just adding a profit target has increased your return to a positive return, which is great. Your drawdown's still really bad because you're holding your trade. You're holding your worst trades basically all the time. So your drawdown's still bad, and your worst trade is still pretty bad, 4%, but not that bad at all really. And your win rate on the short side is always not great. But we're going to add a stop loss anyway, just to give it a little bit of room and just to sort of cover the worst of it, I think. So what we'll do is we'll have a 3% stop, and then let's start at 5%. So obviously you can muck around with these. It's one of the first things you should be mucking around with once you've created your strategy. So at a 5% stop, we're not really making any changes. Let's try and see what else would we do on here. Let's try it the other way around. So let's try 3% and 5. Oh no, that's made it a bit worse. Let's put it back to how it was. So 3% profit target, 5% loss, just to cover the worst of it. If we set it say for at 2% here, you're going to immediately go back into a negative return. Again, you're going to get stopped out before your trade has a chance to make the profit. So, and your worst trade is still the same, and your win rates come down, your drawdowns got worse, that kind of thing. So I'm going to keep it at 5%. So we never really have a trade that is any worse than this. And then let's add back in, and we make a nice positive return. So, and then let's go and add back in our long side. And what do we have? So we've made 346% overall. The drawdown is at 18%, which is good. We've got 190 trades, which is enough to be statistically relevant. We've got a really nice win rate, 67%. The worst trade is still that one on the long side, which was an 11% loss. But overall, you're in the market only 60% of the time, and you're making around 60% of the value. But you've significantly reduced your drawdown, so that's all pretty good. So if we wanted to have a look at our profit and loss graph for this, these are important. I'll show you in a minute. I'm just going to grab this code snippet here and set this up. And then I'm also going to come here and grab in the code snippet for the Monte Carlo simulation. And I'm going to add that in here. So I don't want to save the charts, so I'm just going to get rid of that bit here, and I'm going to change this to CMB strategy. That's our P&L chart. And then for our Monte Carlo simulation, I'm going to do the same thing. So I don't want to save the chart, so I'm going to get rid of that, and then I'm just going to amend the chart title. So if I now run all that, let's go and have a look. So for our profit and loss, then all we're saying with this code is to create a variable called trades, from which we take the actual trades, so the actual trade results in order, the total list of trades from our stats here, and then from that take the cumulative P&L, which is the P&L figure using the cumulative sum method. So we're creating a new thing, and then we're just displaying that on a chart here. So you can see the P&L is pretty decent. but P&Ls are important because you want to know the worst that could happen to your strategy. Otherwise, if the worst does happen during your strategy, chances are you're going to stop using it before you end up making the gains. So, for example, if you were unaware that your strategy could drop from a 200k profit all the way down to 150k profit, over a 6-month period, where basically it's just losing trade after trade, then you're going to give up on that strategy before then it has the chance to make these gains. So, always good to have a look at that. It was that, by the way, that period of time I think was when the Qs were falling anyway, as in general. So I mean, there's no shame in taking your strategy off while a bear market's underway. But there we go. So P&L's there, and then for our Monte Carlo simulation, this does a similar sort of thing, but it takes the return percentage. So it's based on the percentage, and all it does is this function here randomizes the order of those trades. So the percent return from those trades, it randomizes the order, creates 100 different variations, and then displays them all in one chart. And you can see actually it's pretty good. What it's designed to do is to show you, or this particular one for this strategy is pretty good. So, but what it's there to do is to show you what would happen if all your losing trades came first. So in your worst simulation here, you were down nearly 35% before it started going, and that was so your first 15 trades were losers basically. So it all came all at once, and then you started to sort of make gains there. But it's meant to show you could this strategy, or based on past data anyway, would this strategy lose me everything? So, and in this case, it wouldn't. So, you're absolutely fine. Yeah, you would be down 35% under your worst base. But on your best one, you'd be up 50% after the same, or up 40% after the same number of trades. So, there you go. So, all right, so that's the money. So where then, now that we've got all this set up and we've got our strategy and we sort of understand it, what can we do then to play with to this to try and sort of optimize it a little bit? And the areas that you could focus on obviously are first of all your RSI values here. So you don't need to use 14 and 3. You could keep all this the same, but use different RSI values. In fact, we're going to try that in a minute. You could also change your fast and slow lines here. So you don't need to use 13 and 33. You could use something completely different. You could change this RSI momentum. Instead of using a 3-period simple moving average, you could use 5-period, 7-period, and also your rate of change. It doesn't have to be 9-period rate of change of 14-period RSI. This could be 8-period rate of change of 50-period RSI. So these are all the areas that you want to play with. And then of course, the one where you should start always is your stops and losses. So you could probably play with these figures. I've not really explored it too much. Something that you can do, but you could probably play with these figures a little bit to get better returns. So let's do that then. So this was the first thing I tried, by the way. And typically, when I have an indicator like RSI, which is extremely choppy, then the first thing I try with any strategy is to, if you want to sort of reduce the noise, then you would increase the look back period, because with something like RSI, which basically oscillates really fast between 0 and 100 all the time, it can give you a lot of false signals. Yeah, you want something that is oversold to trigger a buy, but you want good buy signals, or anyway, to do that you would just increase your look back period, and that's the only thing I'm going to do today. You can explore it yourself. So all I'm going to do is double the RSI periods here. So what was 14 and 3 is now 28 and 6, and then the only other change I'm making to the stops and losses is that we are going to make the stop loss 3% and the take profit 5%. So, and everything else is going to stay the same. So if I now run that, and you can see the change it makes to the indicator. So it's a lot smoother. It's a lot less. What was a jagged move up and down, and here it's a lot smoother. So, but that has improved our lot immeasurably. So you can see now you're in the market 56% of the time. The return is 602% versus buy and hold 611. Your drawdown is still only 19%, which is pretty good. You've got enough trades to be statistically relevant. Your win rate is still the same, 67%, which is very good. Your worst trade's slightly worse, 12%, but overall for the return that it's giving and the reduction in market risk and drawdown metrics, that kind of thing, this is a brilliant strategy to use. Your P&L is more or less the same but a lot smoother. Like there was a big pullback here that you're not seeing in this particular P&L graph, but you still get your one during the bear market. It still loses money. So October 2021 260, March 2022 199. So you still lost 60k during that period, during that bear market. But overall, really good strategy. And then have a look at that. That is what you're looking for in a Monte Carlo simulation. A really nice bottom left to top right profile, a really nice steep incline. And even if your worst strategies came in there, you would have been down 28%. So if you started and then immediately we just moved into a bear market in this and you kept the strategy running, the worst it would do, or based on prior data anyway, is it would have lost you 28%, which is really good. So really good strategy, really nice this one. Again, I haven't played with this a lot, so there's probably bigger gains to be had. Bearing in mind the drawdown metric is so low, could you use leverage? Well, yeah, you could. And it's not going to change this or this, but it is going to it's going to double that. But I mean, the return is going to be insane. So if I use 2-to-1 leverage on this and then hit that, the gain is 4,000% versus 611% buy and hold. So, but I mean, I never use leverage. So there you go, 602%, still a really good strategy. Pleased with that one. If you have any questions about it, feel free to email in. The email address is info@bubble-analytics.com. Thanks now. Bye-bye.